any administrative issue to do with distance learning?
Yeah, Professor. I
Yeah.
just saw that it says, distance learning till continues till June 15. So does that mean we don't come back to the semester at all?
Yeah, that means you don't come back. And the reason it says June 15th, if you'll just bear with me, I'll just show you. That doesn't mean that you necessarily have to be, in a class until June 15th. It's just that that's when June 15th is when the grades are due by, faculty have, this is the absolute last day we can submit grades. So June 15th is basically the end of the semester. So you're right. We were always like, when they switched to distance learning, it was always going to be for the rest of the semester. That was the way it was announced. That we're, because it's such a massive undertaking, and CUNY is such a massive organization or school or whatever, it's impossible to switch to distance learning and then kind of, maybe once things are under control with coronavirus, to then switch back. It's just too disruptive. So they kind of just went straight for everybody has to, skill up and be distance learning, and it's for the rest of the semester. And then in spring 2, which would start excuse me, well, if you take weekend classes June the 20th, but if you do weekday classes June the 22nd, by then we would probably have to gauge where we're at with the virus and everything. And it's maybe more likely that those classes will happen in person if you did in fact register for in-person classes.
So what about if like this is your last semester? Because for me, this is my last semester, and then I'll be graduating. So I'm kind of like confused in that sense.
You're confused about graduation, or confused about what are you like? Tell me more so that I
Like,
can
yeah,
make sure I'm answering
graduation,
your question.
because like how everything is being on distance learning, so I'm not really sure what's going to happen with the graduation.
Well, yeah, I mean, commencement was supposed to be on June the 16th. It's everything, I'm sorry to say, is up in the air because of coronavirus. I mean, I don't know exactly where commencement was set to happen, but I mean, in the past, we've had commencement at Javits Center, and right now, Javits Center, is a hospital. We've had it at Queen's College. Um, Someone saying we're going to graduate through webcam. Oh gosh. Yeah, so what I would think, unless maybe did I misunderstand where you, oh, I thought you were for real there, Carrie. What I would think is that they'll probably postpone graduation and have it on another day at a time when it's safe for big amounts of people to congregate. But
Yes.
that doesn't change the fact that you would have graduated. I mean, commencement, which is the walking, is a ceremony, but your actual graduation from LaGuardia will just be dependent on you successfully completing your courses for the semester. So once that's done, you would be able to get your diploma regardless of whether you march in a graduation. But, the way I know LaGuardia, how they operate, and how important we all feel that graduation is because of how our students overcome so much to graduate, I think they will probably try to postpone the ceremony to another date so that students would still be able to walk. It will just depend on availability of venues. That's the only issue.
Okay, because I'm not looking forward to graduating from the Zoom University.
Well, Carrie was saying that we're going to graduate over webcams. So, I mean, you have to find humor in there somewhere. But yeah, unfortunately, it's really, I feel really bad for people who are finishing. I mean, I feel bad for us all, but especially for people who are, I mean, this is like the last semester you're finishing up. It's supposed to be a very, celebratory time and looking forward to marching and graduation. I also normally attend as faculty. I love to see the students walk across the stage and so on. So it's a big loss. I totally empathize with that. I will say though that I'm sure that the school will try to have an alternative. If by some miracle, at that point things are back to normal, which, you know, I think is wildly optimistic, then they would have it. But, you know, we have to wait for the feds and the state to even tell us that it's okay to do these things, because even if things are deemed somewhat safe, we still have to be careful about 1,000 and something people congregating in one space. You know what I mean? That's really
Yeah.
the bigger issue, more so than whether we would be able to go outside of our houses.
All right. Thank you, Professor.
All right. Any other questions?
Yeah, Professor, as you mentioned earlier, for 2020 spring semester session 2, that means that starting June 20, we will have in-person classes.
I can't say that. I wish I had a crystal ball. What I can say is that it depends on how things go with coronavirus, and whether we are, remember, all of this is about, like, groups of people are not supposed to be congregating because of the risk, right? So, I mean, it could be that we are able to go outside of the house and all of that by then, but I just don't know if classes will commence in person, because it's all got to do with how the curve goes. And I mean, we have not yet hit the apex of the virus. So I almost feel like maybe by mid-May, we would be able to at least have some idea of whether we might return to some sense of normalcy. The hope is obviously that by June the 20th, which is the first day of Saturday class, June the 22nd, weekday classes, that we would be able to meet, you know, if you signed up for in-person classes, that you would be able to meet as such. But, you know, it's almost prophetic now to be able to say that what's going to happen. We just don't know. You know, people have all kinds of plans and stuff for June. My sister's supposed to get married. I mean, just on a personal note, on the 28th of June, and we're even concerned that probably won't happen. So it's in the same time frame, you know.
Did you know that there's a new virus coming out too, Contra virus?
No, I didn't know, and God forbid, I feel like I don't know.
Yeah, people are having it. It's coming up on the news and online and social media.
Yeah, well, I'm very sorry to hear that, and it's so overwhelming to read the news and all the stuff that at times I actually just try to. It's not about putting your head in the sand, but actually try to do something else, because I feel like I'm actually just going to lose it, you know. And I'm sure many of you are like me. I've got family all over the world, and everybody's implicated. I've got parents who are older. I've got parents on lockdown, and so it's hard to even fathom that there's something else coming around the bend. But, you know, to your original point, I don't know, but certainly there will be communication. And by the time we wrap up, you know, around the 8th of June or so, we will definitely have had to have received some indication as to what's happening with those spring 2 classes. All right?
Yeah.
Anything else, folks, that you are wondering about? Okay, so last time we finished up with, you may remember, issuing stock for services or non-cash assets. We went over stockholders' equity section of the balance sheet, which I will revisit in a minute here. But today we're going to talk about accounting for treasury stock, all right? And then we will also talk about accounting for preferred stock and preferred stock dividends. Once we've gone over those two sections, then we'll basically, for the most part, be done with this chapter. But I just want to put out the warning that chapter 13 and 14 are connected to each other in a big way, in the sense that you can't just, you know, like how chapter 12 was kind of its own thing, and we said, okay, once we're done with that, we're done. 13 and 14 have you know, parts of each other within the chapters. So you want to look at them as a unit. And I'll probably start some of chapter 14 with you today. So to talk about treasury stock here for a minute, if I go back to, in Wiley, remember the other day on Monday, we were looking at illustration 1311, which was the stockholders' equity section of the balance sheet. And, we walked through basically every element. And for those who missed that class, remember that all the calls are recorded and they're on my YouTube channel. Just search for Andrea Francis. So we spoke about treasury stock briefly, and we said that treasury stock is basically all the shares that the company bought back from investors. So it's being held by the company. So excuse me, before we got to treasury stock, we spoke about common stock, and we said that outstanding means that these shares are being held outside the company. And we said, 400,000 shares were issued, but only 390,000 are outside the company. So where are the other 10,000? And then when we scrolled down, we realized that 10,000 of those shares were actually held by the company itself. Now, it might sound strange, you would think, because it's like, why is a company holding its own shares? Aren't we normally dealing with investors buying the shares, not with the company? But sometimes companies do buy back. It's called share buybacks. They do buy back their own stock for various reasons. I think I mentioned in Monday's class that especially now, I'm sure you know that many of the airlines are really battling to survive. And the reason for many of them struggling like this is that, they didn't follow what we would call the rules of personal finance, where if you want to really get your finances in order, you make sure that you have enough money to function for 3 to 6 months in case you lose your job or something like that. What the airlines did was they had all this cash on hand, and instead of keeping most of it on hand, they actually went and bought back a lot of their own stock in the market. And why do that? For various reasons. They may believe, one, they want to send a signal to investors about their belief in the company, that they believe that the company is doing so well that they're even willing, to buy back some of the stock. Another reason could be they want to push up the stock price, because the more demand there is for the stock, the higher the price goes. Another reason could be that they want to buy back stock so that they can distribute it to employees through an employee share option plan, and so on. So there's a number of reasons why companies would do this, but the point that we have to remember is that that's what treasury stock is. Okay, it's shares that were outside, held by the public, and the company goes and buys them back from the public and holds them inside the company. And it's possible that the company can actually sell those shares back to the public at a later stage. Now, for a company like Boeing, for instance, now that used so much money to buy its own shares, unfortunately, it doesn't make sense to go and sell those shares back to the public now, because their stock price has dropped, dramatically in this time. So they're not going to be able to get as much money, as for the stock as maybe what they had bought it for in the first place. Who's going to tell me how much was the cost per share? If you look at this, it's 10,000 common shares and they have $80,000 of treasury. $8. So they paid $8 per share, right? 80,000 divided by 10,000, they paid $8. So that's the cost of the treasury stock. And this is an important concept, because when we go through the theory and some examples here in a minute, you have to remember that the treasury stock goes into the account at cost. So it's not going to be to do with par value, because if you look up here, you can see that the stock has a $5 stated value, right? But it's not 10,000 times 5 is 50,000. There's a whole different price here. And this price of $8 is what the company actually paid to buy those shares. That's the cost, and we use the cost method to account for treasury stock. So when we buy treasury stock, they go into the account at the cost of whatever we had to pay for them. When we sell the treasury stock at a later stage, they go out of the account also at cost. And then the last thing that I'll say here is that treasury stock is the nature of the account. It's going to be, all these all these capital accounts are normal credit balances. They increase on the credit side, but treasury stock is a normal debit balance. All right, so it's basically what's happening here is that we're saying that the treasury stock number has to be subtracted from the rest of the stockholders' equity, because stockholders' equity is what is held by people outside of the company, and since this is held inside the company, we deduct it. And so because it's a subtraction, it's also a debit balance, and it's called a contra equity account. Okay, contra equity. So you might remember we had accumulated depreciation, which was a contra asset. We had allowance for doubtful accounts, which was also a contra asset. So treasury stock is a contra equity account, meaning it's an equity account. And I'll just write it here in the notes, because I'm sure people want to see me, or maybe you want to see me write it. So it's a contra equity account, which means it is an equity account, but it has a debit balance. All right. So that's important to remember. And so that also then it becomes a subtraction from the rest of stockholders' equity. So it's a little bit strange, but if you remember what the purpose of this account is, to show the stock that's held by the company inside the company, then it kind of makes a little bit more sense as to why it has to be a debit balance. And I'm in the notes for chapter 13, which most of you have access to already, because we've been using them for about 3 lessons already. If you don't know where they are, or you just joined today, you go to our Blackboard and you go to Zoom call materials, and we've been busy, right? So ignore anything to do with chapter 12 for now, but there's the chapter 13 class notes. You can just pull them down from the Zoom call materials. All right, so treasury stock is the company's own stock that it has issued, meaning it was sold to people outside the company and subsequently bought back from the shareholders, but not retired. Retired would mean that they take the stock completely out of circulation, so it's not going to be reissued to anyone outside. So this is not retired, it's just being held by the company, and the company can then decide afterwards whether they want to keep holding it or whether they want to sell it back. And I already discussed the reasons why a company would do this. How do we account for the purchase of the treasury stock? We have to use the cost method. That's what I just discussed. Remember, we just looked at it. We said, what was the cost of this? It must have been $8 a share. So they use the cost method to record the amount in treasury stock. Under the cost method, the company will debit. So there we have it. Remember, it's a contra equity account, so it goes up on the debit side. When we buy the treasury stock, we debit the treasury stock account. It's increasing for the price paid to reacquire, to buy back the shares. And the credit goes to cash, because we have to pay whoever is holding that stock, we have to pay them, excuse me, in cash for the stock, and we will record the treasury stock ourselves. I think we'll do example 12 in a minute here, but I think this is actually what I was typing up top. So you do have it in your notes, apologies. So treasury stock is a contra stockholders' equity account. So it's deducted from the total paid in capital and retained earnings, deducted from stockholders' equity, up on the debit side and down on the credit side. Because of that contra stockholders' equity, companies disclose the number of shares issued and the number in the treasury. And the difference between the two is whatever is outstanding. And what does that mean? Going back here, we disclose what was issued, total 400,000, only 390 is outstanding, which must mean that 10,000 is held by the company. Any questions on the theory before we do an example? Excuse me. Nope. Okay. So I'm looking at example 12 on the company's exercises. If you are looking at the spreadsheet as well, it's going to be sheet 2 or the second tab. So because if you scroll down on the first sheet, you see that it ends at example 11. So just go to the second sheet, which is that's where example 12 and the rest of the examples are. So let's read and see how this question is presented to us, and then we can kind of try to figure out how to deal with it. On February the 1st, 2018, Mead Inc. acquires 4,000 shares. So this is where you want to be careful, because this can get very a little bit confusing, because you could get confused between when companies are issuing stock and when they're actually doing treasury stock. You see here how it says of its, right? Of its stock. So this word, it's such a small word, but it's basically telling you that the company is buying back its own shares. So it acquires 4,000 shares. There's the number of shares of its stock. $8 is the cost. Remember, we said we deal with the cost method. Notice how there's no discussion of par value here, and even if there was, you wouldn't use the par value to record this transaction, because you are using cost method. So it's saying to prepare the journal entry required. So I'll go back to where I was keeping a running workings sheet. Let me just, okay. If you're, just as an aside, if you're looking for this sheet where I'm doing all the workings on every call, I'm, excuse me, I'm posting them also here. So March 25, March 30th. It's the same as the answers to, for the most part, the answers to the chapter. But sometimes when I'm doing examples, I kind of give extra information or something. So, you're welcome to look at those calculations as well. So example 12, let's see what I'm doing now. So we need to make a journal entry for the purchase of the treasury stock. I need to make this a little bit smaller, otherwise you guys won't be able to see. All right. So we already said that we debit treasury stock, Contra equity account, right, going up on the debit side, and you're going to debit it with 4,000 shares times $8. So 32,000. And the credit here is for the same to cash, because you're paying these people in cash. Cost method, only use the cost of what you actually paid for the shares. Even if a par value was mentioned, it doesn't matter. You shouldn't use par value. Questions there? Oh, simple enough. I don't think this is a. Let me see if anybody's looking for me on chat. Nope. Okay. Right, I'm assuming no news is good news. People understand what's happening. So example 12 continued. What happens in the financial statements, right? If we have treasury stock, we've already kind of discussed this a few times, that it has to be a subtraction, but this question is asking me to just build the balance sheet to show what this would look like. So I'll do this with you, just also as a kind of additional practice of, the steps for building the balance sheet. So I'm going to go back here and build the balance sheet. So the company's name is Mead Inc. This is like what we did on Monday, right? We're doing a partial balance sheet because we're only doing stockholders' equity. Sorry, I didn't really read the question, but sorry, let me just go. Assume that stockholders' equity section of Mead's balance sheet contains 100,000 shares of $5 par value common stock outstanding, all issued at par value, and retained earnings of 200,000. Prepare the stockholders' equity section of Mead's balance sheet. We won't do it before because we know how to do that also already, but after the purchase of the treasury stock. So they tell you the balance in retained earnings, but they don't tell you the balance that you would put for common stock. Can someone tell me how we would calculate what the number should be for common stock? What should be the dollar amount that goes into the common stock account on the balance sheet based on the information that we are being given?
500,000.
That's correct. And how do you know to do that?
Because 100,000 shares times $5 per value.
Par value, right? $5 par value, and in this case, the stock was even issued at par value. So it's which is kind of irrelevant information because the formula, as we know from long ago, the formula for what you put into the common stock account is the par value times the number of shares, right? Thank you. So par value times the number of shares. So we know that the common stock balance is going to be 500,000. Retained earnings is going to be 200,000. Based on our calculation with the journal entry, treasury stock is going to be 32,000. So we basically just need to build, build this balance sheet. So I'm going to put the heading stockholders equity. That's the main heading. Remember, we've got these millions of headings. Paid in capital to show the capital that was actually paid in, not earned. At that point, you differentiate with capital stock, which is relating to common stock and preferred stock. Again, this is all still just headings. And then you put common stock, right? So normally companies would put the, so many shares issued and outstanding and what's the par value. But remember I told you that in Wiley, they're just looking for the account name. They're not actually expecting you to put all the features of the stock. So I'm just going to put it like this for now. And you already told me it's 500,000, right, for common stock. And then, again, this is a little bit silly because there's only one balance, but theoretically we would say total paid in capital. If there had been preferred stock and common stock, you would obviously have more than one line, right? Do we have additional paid in capital? No, we don't, because it said that the stock was issued at par value. So we don't have to be concerned about any additional paid in capital. So we can immediately move to retained earnings. I repeat, there's no additional paid in capital because the stock was issued at par value. I'll just scroll back up from some days ago when we did stock issuance at par value. This was like from the first, I think maybe the first example that we did over here. The issue price was $2 and the par value was $2. Notice how there's no paid in capital in excess of par because the issue price and the par value are the same. So when we're building this balance sheet, we don't have paid in capital in excess of par. Stop me if I'm going too fast or if I lost you. Okay, I don't want to. There's no need to rush, but if people don't ask me questions, to most extent, I'm assuming that you're understanding what I'm saying. So retained earnings, this number came from the question. I didn't calculate it. It's straight from the question. So this now is going to be total paid in capital and retained earnings. And so that's going to be the sum of these two numbers, so obviously 700,000. And then we come to, I'm just skipping some lines so that it's easier to read the stuff. Then we subtract the treasury stock, right? And yeah, because I'm saying less, I don't necessarily have to put parentheses around the number, but if you want to, you can. And then at the end, you've got total stockholders equity. Just remember to subtract. That's, that's the main thing. 668,000. Questions there?
Yes, Professor, can you explain to me from where you left off at common stock?
Yeah, so you're okay with where the common stock number came from?
Yeah.
You sure it's 100,000 times 5, right?
Mhm.
Over here. The retained earnings is just given in the question. So
Okay.
that's not something that we calculated. So the total paid in capital is just, I'm following, who's speaking?
Tiffany.
Tiffany, I'm following the format that we have in the book. So that's how I know which words to, which names to put in.
Okay.
Yeah, so this is something that you would just have to practice a few times. And the other day I was also saying,
Right.
when you're doing a test or whatever, you can just have a reference sheet. I don't expect you guys to memorize every step, because that's not the purpose of this. The purpose is more to be able to know what belongs in the balance sheet and how to arrive at those numbers. So the total paid in capital is just the subtotal. The retained earnings is given in the question. And then this is also a subtotal that I only know that because because I looked over here. I mean, I know it obviously
Right.
because I'm teaching the class, but how would you know that? Because you have to look at the subheading to know what to put over here.
Right.
So 700,000. Then the treasury stock I know because I know it has to be subtracted. So I'm doing kind of the same thing, and then the final balance is total.
Okay. Total. Okay.
Got it?
Yeah, I got it.
All right. So that's the balance sheet after the treasury stock was purchased. If you had to do the balance sheet before the treasury stock was purchased, this piece would be gone. That's it, okay? Which is why I didn't build both balance sheets, because it's too repetitive. So basically, before treasury stock, this piece over here just wouldn't be there, and the final answer would be 700,000. So nothing too dramatic over there. Anything else before I throw some examples at you to try and do?
Did we forget the date, or we shouldn't add the date in this?
Why do I keep doing that? It's no. You should put a date. And last time Jimmy was telling me. I think I'm just not. I'm just so eager to get to the work that the actual work that I keep forgetting to put the date in. You should absolutely have the date in. And it seems to be like a bug in my head this semester where I'm not putting it in. You're supposed to have the name of the company, the name of the statement, the date, and of course the balance sheet is at a point in time, not for a period of time, and then you start doing your building of the balance sheet. Thank you. I don't know. I might keep doing that, so just keep reminding me. Sometimes, every semester there's some type of bug that happens, and this seems to be the one for the semester. Anything else?
We're good, Professor.
You're good? Okay, for the most part, okay. So let's look at the example 13, and then maybe you guys can do it on your own. So Drake Inc. purchases 3,000 shares of its $50 par value common stock for $210,000 cash. So again, where you see of its, right? That tells you that this is a treasury stock transaction, which when it's a treasury stock transaction, do we care about par value? Yes or no?
No, just for what it's bought for.
So ignore par value. You use the cost of the treasury stock, and the cost is 210,000 on July the 1st. It will hold the shares in the treasury, so yeah, they at least give you another hint that it's treasury stock until resold. Prepare the journal entry for the purchase of the treasury stock. So this one is different than the other one because over here they tell you the cost per share, but over here they actually just give you the total already. So let me ask, before you guys do the journal entry, what is the cost per share?
50?
Did you say 50? No, because that's par value, so you have to ignore par value. How would you calculate the cost per share?
210 divided by 3,000?
Yeah, so you look at what you paid in total, 210 divided by the number of shares. So it's actually $70 per share. So I'll put it over here for those who didn't see what I was doing. $210,000 divided by 3,000 shares. So the cost per share is 70. Did you need to calculate that for this? Not really, because you already have the dollar amount, but I just want us to be able to know that, you know, in case at a later stage you need the cost, that's how you calculate the cost. Please notice again that the $50 par value is ignored, all right? It's ignored for the purposes of the journal entry. So please go ahead now and make the journal entry for this purchase of treasury stock. All right, I think we've had a decent amount of time. I forgot to check the clock before we started, but this is not the hardest journal entry to do. Can you walk me through what you guys are thinking for the journal entry?
Treasury stock, 210 for the debit and 210 for the credit for cash.
So treasury stock debit 210,000, absolutely. Oops, sorry, 210,000. This is how simple it is, right? And cash credit for the same. If you put 3,000 times 50, you know, again, the $50 is irrelevant. You don't concern yourself. I know it's difficult because we've been going on about par value the whole time, but the $50 doesn't factor into the calculation over here. You only go with the cost of what you actually paid for the stock. Ignore par value for the purposes of treasury stock calculations.
So we just have to be careful when we read the thing is of its that does let us know that is the company
Yeah.
coming back, and then just if they give us the amount, then that's the amount that we read.
Yeah, because I've seen people not read the question properly in the past, and they don't see of its, and they just assume that this is a stock issuance, and they, you know, they debit cash for 210, they credit common stock for whatever this is, 150,000 or whatever, and then put the rest into paid in capital in excess. That's completely wrong, right? Because of its, to your point, is that this is treasury stock, so you're not doing a stock issuance, you're doing a stock buyback. All right, so to recap, ignore par value, use cost. What is the cost per share? In this question is $70. We didn't really need it because we had the 210,000. You debit treasury stock 210 and you credit cash. And so that was the purchase of, you can see here, treasury stock purchase. It's possible that a company could also sell its treasury stock after, at some point after it purchased the stock. It may see that the stock price is doing well, or the company might need some liquidity. So they decide to actually sell the treasury stock back to, the outside investors. So this is what's happening here in example 14 and 15. Example 14 is relating back to 12, where Mead Inc. bought 4,000 of its shares, and example 15 is related to 13, where Drake bought some of its shares. So I'm going to do 14 with you, and then 15 you guys can practice on your own to see if you actually are following what's happening. So notice that this is treasury stock that is sold back above its original cost. If you look in the textbook, you will see them covering some pieces about let me just go back here. You will see them covering some parts about treasury stock that is sold below cost. That's outside the scope of our work. So treasury stock above cost, yes, we should be dealing with that. When it comes to treasury stock below cost over here, it's not necessary for you to concern yourself with that, because then it gets all wacky, and it's not part of our necessary for our syllabus. So just know that you will only be asked about treasury stock being sold above cost, not below cost. And by cost, we mean, for the purposes of example 12, cost was $8 per share. So you would be looking at treasury stock being sold for more than $8 per share. So example 14, on July the 1st, Mead Inc. sells for $10 per share. Okay, so there's the resale price now, the issue price. They're going to get $10 per share for 1,000 shares of treasury stock previously bought at $8 per share. So now we have to journalize the sale of the treasury stock. So the company is selling something for cash. So obviously they're going to get some cash, and then the rest of us, we're going to have to figure out how that works. So for example 14, cash is going to be the actual amount that you're selling the treasury stock for, which is $10 per share times 1,000 shares. Okay, that's how you calculate the cash piece. 10,000, and then you've got treasury stock that you have to now get rid of. Remember, when we purchase the treasury stock, we debit it. When we are selling the treasury stock, we will obviously have to credit. And you are not, please listen carefully to what I'm saying, you are not going to credit the treasury stock with the $10 per share. You are going to go back and see, what did we originally pay for this? Oh, it was $8. This is the cost method, right? Since we bought it at $8, when we sell it, we also have to take it out at $8 per share. This is normally where people mess up on these questions, because because they put just 10 here also, and then that's not the right answer, because remember, if something went in at 8 and it comes out at 10, then there's a mismatch, right? Then you've actually accounted for more than you should have. So obviously there's a problem here now, because you've got 10,000 on the debit side and only 8,000 on the credit side. So 2,000 is missing, and you'll already kind of maybe be able to guess what the name of this account is going to be. It's paid in capital from treasury stock, because people are paying extra, right, for the stock than what it was being held at. They're paying $2,000 extra. So the excess, just like when we do a stock issuance, for common stock or whatever, the additional money that got paid in has to go into this account called paid in capital from treasury stock. Questions there? All right, so Where are people going to trip up? The usual. Don't use par value. It's unless it says that the stock was, you know, subsequently sold at par value or something. You're always going to use whatever the cash amount is that the company is about to get is what goes into cash. Treasury stock cost method. So if it went in at 8, it comes out at 8, regardless of how much you're actually selling it for. Any excess goes into paid in capital from treasury stock. So example 15, you guys can do on your own. I'll read it with you and then you can practice. On November the 1st, 2018, Drake Inc. sells 1,000 shares of treasury stock acquired on July the 1st. So this is the same transaction. From how much did that stock cost? The stuff that was bought on July the 1st. We calculated the price. How much was it?
It was 10,000. $10 per stock.
No. Remember Drake from example 13? How much did we pay per share?
Oh, 70?
Mm-hmm.
Talking about 13?
This is, yeah. So these shares had cost us $70, right? Per share, based on the information above here. So it says that they sell 1,000 shares of treasury stock for $80 per share. So the $80 is the cash that they are going to receive, and the 70 is what it cost them before. Journalize the sale of the treasury stock. So you guys go ahead and do example 15 based on what we just did in example 14. I'll give you until 11:30 to do it.
So this was the same issue I had before. Every time I read it, see, I thought it was just for 14. And I didn't know that 15 was based off of 13. So yeah, I read it too fast. And that's what caused me a lot of issues.
So, Professor, the only reason why we had this 70 per share is because of the above example, because it's
Yeah, because the example is following on. Yeah.
okay. But if just to like make sure, so if we have a question where it doesn't say something like that, then we just have to find out what was the cost per share, right?
Yeah. So I mean, I guess like if 14 was just a standalone example, the question would absolutely somehow have to give you the information to either calculate what the original cost was, or just actually give you the cost directly.
Okay, thanks.
All right.
Hi, Professor. Can I do the answer in another minute?
Sorry, I was muted. Yes, at 11:30. Thank you.
Professor?
Yeah.
Okay.
Yes, I'm here. Hello?
Um, uh, this
Sorry, you're breaking up pretty badly. I can't hear you so well. Can you repeat what you're saying?
hello?
Yeah. Is it there? There. Are you trying to talk to me? All right. So it's 11:30. So
It's cash for
go ahead.
80,000 debit. Treasury stock is
Okay, wait.
70,000.
Hang on. I'm behind you. Sorry.
Sorry, you know.
So cash. Tell us the formula. It's $80, right? Times
1,000 shares.
1,000 shares. So you go with the
80,000
price,
for debit.
the amount that you're actually receiving in cash. Yes, and now
Now it's a treasury stock for $70 per share for 1,000.
sorry, I have a typo. So treasury stock 70 times 1,000 is going to be 70,000, and then what?
The paid in access capital treasury stock will be you minus the cash, you get 10,000.
Yeah, to balance the journal entry, and that's yes, thank you. That's the answer. So guys, again, normally the problems that people have with this work is they don't read the question properly. They don't follow well, first of all, don't read the question properly to realize that it's a treasury stock question. Secondly, not following the fact that you don't use par value unless the stock was bought for par value or sold for par value. You're actually using the cost method. So the treasury stock goes in at whatever you paid for it and it comes out at the same. All right. And cash is a fact, right? It's based on the actual amount of money that you're supposed to receive. So don't change cash to be, the cost method, or changing cash to be, somehow linked to par value or something like that. That's not how to go about this. I'm saying this because normally treasury stock historically, in my experience, has given students a lot of problems. And I think it's because we just came off of doing all these examples with par value and how to use par value and all of that. And suddenly you kind of have to throw that away to just use the cost method. Just think of it as a separate topic and a separate treatment of, of a stock purchase, of the buyback and the issuance. Any other questions on treasury stock? Because that's kind of it for treasury stock, and we have to move on to issuing preferred stock and doing preferred stock dividends. Any questions for treasury stock?
Yes.
Go ahead.
I kind of got confused. I get the part till where you have to do the treasury stock 70 times 1,000, but where I'm getting confused is paid in capital. So you're minusing the 80,000 from the 70,000 to
Yeah,
get.
you're literally just balancing the
Okay.
journal entry. Yeah, there's no fancy. Well, I mean, you can say, okay, this was issued at 80, this is 70, so 10, right? 10 is the difference. 10 times 1,000 is 10,000. But the easy way to make sure your journal entry also just balances is to just say 80 on the debit, 70 on the credit. So the credit still needs 10. So I gotta put 10 in there.
Okay, I got it. Thanks.
What else, guys? That's it? Okay. So let's go and read up a little bit on preferred stock, and I'll just keep saying this, and you'll see it when you're doing the homework, and you know you'll curse chapter 13, but the chapter has a lot of small topics that you have to kind of keep your head straight here, where there's just like a lot of things that you know you have to keep under control. So please be sure, one, not to leave the homework to the last minute, because you're going to become flustered for sure, because there's just so many different things to keep track of. Also, if you feel like you're losing, you know, touch of all the different topics, this summary of notes does help a little bit to just remind you of which topics are being dealt with in the chapter. Obviously, you should read the chapter, but excuse me, if you just want like a quick reference guide to see where, you know, you're looking at a question for homework and you're like, what is this? I don't even know where this fits in. Maybe look at the notes to say, oh, okay, now I see it's supposed to be like a sale of treasury stock or something. And, you know, just to wrap up the treasury stock thing, I didn't read this previously, but here's a little blurb also about how to deal with the sale of a treasury stock at or above cost, right? We've already done the journal entries. Now, preferred stock, if we go back to our trustee balance sheet here, preferred stock, we already said, is a class of stock that the company has. It's by, you know, just by virtue of the name, you can hear that it's, you know, given preference above common stock. So you should say preference for what? Well, preferred stock as a preference in that they receive their dividend. If a dividend is declared, they receive their dividend before common stock receives their dividend. Also, in the event of a liquidation, the preferred stock is going to be paid out first before common stock. So hence the name, and preferred stock is always listed first, you know, under capital stock, to again just show this kind of preferential treatment. The preferred stock is normally also, you know, described in terms of its features. This 9%, I discussed this on Monday, but it bears repeating because we're going to keep coming up against this. The 9% is saying that there's a 9% dividend on the $100 par value for each share that the company, I mean, not that the company, well, that the company issued, but that investors own. So if I own one share of this company's preferred stock, I am entitled to a $9 dividend per year. And because this preferred stock is cumulative, the word cumulative meaning that things are adding up, because it's cumulative, it's also saying that I am, excuse me, that I am expecting to receive the dividend, and if I do not receive the dividend, then I actually will end up the following year. So if this year I don't get my $9 per share, then next year I have to get $18, because I have to get the $9 from 2020 and I have to get the $9 from 2021. All right. So this is the nature of preferred stock. What we're going to look at now is accounting for preferred stock, meaning doing the preferred stock issuance, like how we did the common stock issuance. And if you don't know what I mean by the common stock issuance, going back here where we said accounting for issues of common stock, and we debited cash and we credited common stock and we credited paid in capital in excess of par or stated value. We're going to do the same thing for preferred stock, and literally the only thing that's going to change is this. Instead of saying credit common stock, we will say credit preferred stock, and the paid in capital in excess of par will just be for preferred stock instead of common stock. So please don't worry too much, because this is actually this piece is actually, you know, somewhat repetitive, because we already kind of know how to do these issuances. We just have to change the name of the account to preferred stock. So preferred stockholders have priority. I already said this with respect to distribution, so dividends and also the assets in the event of liquidation. However, they generally can't vote. The common stockholders can vote. They can vote on the board of directors, like who should be on the board of directors. They can vote on many other things. Sometimes preferred stockholders can vote if their dividends are in what we call in arrears. So if the company hasn't paid the preferred stockholders for a long time, then they are allowed to vote because they want to be able to say how the company should spend its money, since the company is not actually paying them what they are owed. So a company can issue preferred stock for cash. It can also be just like what we had with common stock. It can also be issued for non-cash assets. Preferred stock may either have par value or no par value, just like the scenario that we had with common stock. Right, that you can have par value, you can have no par value, or you can have no par value with a stated value, right? Those are all the scenarios that you can have with preferred stock. And then, as I said before, when we're looking at the balance sheet, preferred stock is always listed first in the paid in capital section of stockholders' equity. I'm not going to open it now, but you saw it before when we looked at Amazon's financials. You saw also that even though Amazon had not issued any preferred stock, the preferred stock was still listed before common stock, just because, again, it has preferential treatment. So those are the kind of the things that you want to be thinking about as it relates to preferred stock. Does anybody have questions yet on the theoretical side of things before I do an example with you? Okay, so I don't think we have questions, so that's great. So looking at example 16, preferred stock on July the 20th, 2018, Reyes Inc. issues 1 million. So there's the number of shares being issued, $2 par value. There's the par value, 5%. So I'm going to stop here. You see this 5%, and you may be tempted at this point to say, uh-oh, how do I apply the 5% to the stock issuance, right? Like, how do I treat this 5% when I'm doing issuing of stock? You ignore it, okay? The only time you need to deal with the 5% is when you are calculating dividends. And in this issuing of preferred stock, you're not going to calculate dividends. We'll calculate dividends later. So this is just telling you it's a feature of the preferred stock. It's like saying, someone has brown eyes. It's not relevant right now, but later on when we do the dividends, then it will become relevant. So you focus on the 1,000 shares that are being issued, $2 par value at an issue price. So there's the other thing that you need, right, to be able to record the journal entry. Remember, you need the number of shares, the par value or no par value with the stated value, and then the issue price. So we have all three things that we need to prepare the journal entry required for the issue of the shares. So I'll go into my worksheet here, and so
it'll be cash for 5 million.
Yeah, but so let me also just say this, that you want to now again be careful with not getting confused with when we were doing treasury stock, right? This is you're back to a regular stock issuance, okay? So you debit cash with the issue price, which is 5. So yes, Jeremy, to your point, times 1 million shares, right? Which is going to be the 5 million.
And the next one's the preferred stock.
Exactly. So instead of, in the past, we were saying common stock, now we're going to do preferred stock, but guess what? The formula stays the same, like when we did common stock. So you're saying the par value, right, times the number of shares. So same formula, same approach, different name, but the same approach. Let me just make this a little bit smaller so everyone can see what's going on here. So, and then of course,
Paid in capital for preferred stock.
Exactly. There's 3 million missing because we have to balance the journal entry. It's going to be the same name, paid in capital in excess of par value, but it is going to be for preferred stock instead of common stock. So what changed? We've got a name change on the account over here, and we've got a name change on the account over there. But hang on, did this actually take? No. But other than that, everything is the same. And how did we get the 3 million? You can just plug it in, right? You're just saying 5 million minus 2 million. Or you can do the long way where you say, okay, it was $5 issue price minus the $2 par, so it's a $3 excess times a million shares. Same answer. Questions there, anybody? We're good? Okay, so let's do this. Let's take a break here for maybe 10 minutes to 11:55. I need to find my charger because I realized I didn't plug myself in, and maybe people just need to stretch their legs. When we come back, you guys will do example 17, and then I'll take you through the dividend stuff. So I'll see you back here in 10 minutes, 11:55. All right, I'm not gonna be on the call probably for about 5 minutes while I just figure out my charging my computer. All right. Okay, I'm back if anybody wanted to ask me anything. Recording. Okay. I'd like you to do example 17 on your own to make sure that you understand how to do this preferred stock journal entry. So I'll read it with you, and then afterwards you can do the journal entry for the issuance of the shares. On October the 12th, 2018, Wright Inc. issues, there's the number of shares, 150,000 shares, $1 par value. So there's the par value that you need for your journal entry. 6%, remember I said the 6% is just saying the feature of the preferred stock, that it's a 6% dividend on $1 par value. You do not need to use this percentage when you are doing the stock issuance. Shares of preferred stock at an issue price, there's the issue price that you'll use for cash of $3.50 each. Prepare the journal entry required for the issue of the shares. So you're following a very similar approach to what we were doing before. And go ahead now, and I'll give you somewhere between 3 and 5 minutes to do that journal entry for yourself.
Can I give the answer when it's time?
Shall we take someone else? Otherwise, you're going to do the work for everybody. Let me try and put somebody else on the spot. What do you think?
Okay.
Yeah. All right, who's gonna volunteer here? We had a volunteer, but I'm asking someone else who maybe hasn't spoken yet to give us the answer. Yeah.
With debit cash.
So cash debit. What's the formula there for the debit?
It's
How did you get the number?
1,500,000 multiplied by 3.5.
Yeah, so $3.50 per share times 150,000 shares.
5.5.
Oops, what just happened to my Sorry, I don't know what just happened to my cash. So we're just going off of the question, right? 150,000 shares times 350. So that's 525. I'm just going to type it in. Otherwise, this thing is still going to take long. So 525. What's next?
Preferred stock.
Okay, so preferred stock. Yes.
150,000.
So it's $1 par times 150,000 shares. So you're still going with the formula, right? And then what's the last piece?
Paid in capital in excess of par value preferred stock.
And here you can just balance it. You can say 525 minus 150, 375, or like we did before, you can say, what's the issue price? What's the par value? The difference is 250. Multiply that by 150,000 shares, still gives you 375,000. Questions, anybody?
Yeah, Miss, can you just leave an example 17 for like a minute, please?
Absolutely, no problem.
I took a picture of it. You can move on if you like. Just to not like take the time up.
Yeah, I mean, I'm still open to questions here if anybody wants to ask me anything.
Yeah.
This is the last example we'll do for preferred stock issuance before we talk about preferred stock dividends. Are we solid, guys? Apparently, right? Okay. So that's it. Again, remember, it's just the name of the account that changes. It's the same process like what we did with common stock. If there was no par value, it would be the same as before. All the cash goes to cash, and then the entire amount just goes to preferred stock. They wouldn't be paid in capital in excess of par value. Again, I repeat, if there was no par value preferred stock, everything, the entire amount that goes to cash would also just go to preferred stock. If it was no par value with a stated value, you would just change this word par to stated. Okay, so it's basically the same treatment like with all the stuff that we did with common stock. It's the same for preferred stock, just the account name preferred stock instead of common stock. All right. So the last piece here, this chapter is kind of leading into chapter 14, because in chapter 14 we do a lot of work on dividends. So this last piece here is about preferred stock dividends. Now remember, I had said, and you guys followed that instruction, that when we did the stock issuances, we didn't use these percentages because the percentages are only relevant when we actually do dividend calculations. So we're coming to the dividend calculation now. And as we said before, preferred stock is always paid before common stock, right? So if a company declares a dividend of, let's say,
I can't. What are you doing? Just screenshot. No, I wrote on. Make her go back to example
someone
7.
is not muted, and I hear some commotion in the background. All right. So if preferred stock is standing before common stock to receive dividends, that if the company declares some dividend amount, right, and that may not be enough to cover all of the preferred stock dividend, or it might cover all of the preferred stock dividend, but not not give the common stock too much. It's kind of just too bad for common stockholders. If there's not enough money, they just don't get anything. But if there's a lot of money being declared, as a dividend, then the preferred stock will always only get whatever percentage they are entitled to, and everything else goes to common stock. So it's not that the common stockholders are always getting the short end of the stick. That's not necessarily the case. They just get what's left over. of the dividend that's declared, and sometimes that amount is big and sometimes it's smaller. So the preferred stock dividend, as we said, is often expressed as a percentage of par value. So you might have a preferred stock that's $100 par and it has a 7% dividend per share. This means that it's $7 per share that this preferred stock would get as a dividend. And so, you know, depending on how many shares you have, if you only have one, obviously you only get $7. If you have 10, you get $70. If you have 100, you get $700, etc.
That par value is usually like $1 or $2.
Yeah, so if the par value is only $1, then you would still only get 7% of $1, right? Which is 7 cents. So if if you only own one stock for whatever reason, you only get 7 cents, and you literally would get 7 cents. But if you own more than one share, then obviously it's like in proportion, right? The more you own, the more shares you own, the higher the total dividend amount that you're going to get.
And how
Okay.
about companies with no par value?
Okay, so what about shares with no par value? Then what ends up happening is that the 7% is going to be on the total balance in the preferred stock account. All right, and then that number gets kind of divided between the stockholders. We don't really have examples like that. I mean, it's kind of, obviously you can employ logic, but I'll just repeat. So the question was, what if there's a share that has a preferred stock that has no par value? You would still have a balance in the preferred stock account. So the 7% would be calculated on a total balance in the preferred stock account, and then whatever number comes out of that will be divided up amongst the stockholders based on the number of shares that they own. All right? Daya, was that you? Is that okay?
Yes, thank you. Appreciate it.
Okay. So the stock may be cumulative, and we spoke about this a little bit already. Cumulative means that if we don't get paid, this year for our preferred stock dividends, then next year you have to pay me for 2020 and 2021. So just to go back to this example, if it's $7 per share and I own one share and it's cumulative, that means that in 2020, I'm supposed to receive a dividend of $7. If I don't receive that dividend this year in 2021, I need to get $14 because it's $7 for 2020 and $7 for 2021. That's cumulative. And the $7 that isn't paid this year is referred to as being, let me just type it here. It's here. See, I'm going ahead of my own notes. Any dividend that is declared and not paid, right? It's called in arrears. That means that it's owing. Okay, in arrears, again, weird, English words, but it's just owing. So it's like if you didn't pay your Con Edison bill or whatever for last month, they will tell you that that amount is in arrears. That just means that you owe it. So sometimes when you do calculations, or you'll see in the textbook also, they will talk about dividends in arrears. That just means that it's dividends from previous years that have not yet been paid. If the preferred stock is cumulative. If the preferred stock is non-cumulative, and I don't see that I wrote this here, so let me write it. If it's non-cumulative, you can imagine what this means. It's the opposite of cumulative. That means that if the dividend isn't paid in the current year, it does not carry over to the next year. In essence, the preferred stockholders lose that money. And now you might say, but who on earth is going to sign up for non-cumulative? If that's the type of preferred stock that the company issues, you as the investor, you kind of know what you signed on for. So, you can't really go back to the company and cry and say, I want my dividend. If you agreed to buy preferred stock that's non-cumulative, you understand that you may not get the dividend. and that if you don't get the dividend in a particular year, that you will not be able to carry it forward in arrears. Questions there? All right. So let's look at this example. We will do many, many more examples about preferred stock dividends in chapter 14, but this is just kind of to prime us here for what's coming. So example 18, which is the last of these examples for the chapter, assume that at December the 31st, 2018, Scientific Leasing has 5,000 shares, okay, of 7%. There's the $100 par value. And just to be clear, and to Daya's point also, the par value isn't always $100. For some reason, $100 is coming up a lot in this chapter, but the par value could be anything. It could be $1, could be $50, could be $200. So you just base your calculations on whatever the question tells you. So it's 5,000 shares of 7%. So that's the dividend percentage, $100 par value, cumulative. So this is back to, if we don't get the dividend this year, then next year we have to get 2 times, right, the amount. Preferred stock outstanding. What is the annual dividend on the stock? So I'm going to throw you guys in the deep end a little bit. Don't shout out any answers. Just take 2 minutes and try and see if you can calculate the dollar amount that is the total dividend that the company has to pay on these preferred shares. Again, please don't shout out anything. Let everybody have a chance to calculate. All right. I'm looking, anybody can volunteer now to tell us how you think we should calculate the total dividend amount.
I might be wrong, but I'll give it a shot.
Yeah, being wrong is not a problem. I will tell you if you're right or wrong.
So
Go
it's
ahead.
stock dividends.
Oh, this is not a journal entry. We're just looking for a dollar amount for the total dividend.
Sorry, so it's 35,000.
35 what? Okay, so let's go with, how do we calculate it? We're going to take the par value times the dividend, dividend percentage times the number of shares equals the total dividend. So to your point now, it's going to be 100 times the 7%, which is 0.07, right? Not 0.7, times 5,000 shares equals a total dividend of 35,000. Yes, the dividend is $7 per share, but the total amount times the 5,000 shares is 35,000. Questions, anybody?
And then the next one is
hang on, let me read it. If no dividends were paid in 2018, how much dividend is owed to preferred stockholders at December 31, 2019? Now that we have the dividend amount, let's give ourselves 3 minutes for everybody to just calculate how much you think should, or how much is owed. If no dividends were paid in 2018, how much is owed to preferred stockholders at 2019? Let's take a minute or 3 minutes here until 20 past for people to just see if they can calculate that, and then we'll go over it.
also, Professor, I just wanted to make sure if they asked for a journal, did I did it right? I put stock dividend and then
No,
dividends
it
payable.
won't be stock. It won't be stock dividends because this isn't stock dividend is, and we'll get to this. But stock dividend is when you issue stock instead of cash. So this is just a cash dividend.
Oh, okay. So
Yeah. So
cash dividend, then
and dividend
payable.
payable.
Okay, so I made that wrong thing. And that's the trouble I'm having. Sometimes I put the wrong thing.
This is totally normal for this, especially for these two chapters, because there's so many account names and things to remember. So I know this sounds super boring to say it, but I'll say it again. All you got to do is practice. You just got to keep practicing. And practice means reading the questions, and this applies to everybody. You're reading the questions very, very closely so that you can actually begin to recognize, right, the rhythm of the questions and the words that are used, because that's going to tell you, you know, whether it's, like we said, like whether it's a stock issuance, whether it's treasury stock, whether it's a cash dividend, whether it's stock dividends, but it takes repetition. And once you start seeing the key things, like what I pointed out to you guys on some of the questions, you'll notice that the questions are repetitive. They're all the same. You know, it's just that you need to probably practice one question sometimes 4 times over to see how the language and the rules dictate how to account for the transaction. That's the, so don't get too frustrated with yourself. If you feel like you read something, you can do the question, and then when you come back, you know, half a day or a day later, you can't remember anything. It's the nature of the material that you have to keep practicing it. All right, so no dividends were paid in 2018. It's a cumulative, right? Cumulative preferred stock. So we said before that cumulative means that the preferred stockholders must be paid both current year dividends and any unpaid prior year dividends before common stockholders receive their dividends. So if it's cumulative and I haven't been paid for 2018 and I still need to be paid for 2019, what that tells me is that they owe me $35,000 for 2018. They also owe me $35,000 for 2019 because no additional shares were issued, so the amount of the dividend stays the same for both years. So you're going to end up with a dividend amount of 70,000. And so the 2018 is what was in, as we say the word, right, in arrears. That's how we call it, because it hadn't been paid yet. 2019 is the current year's dividend that needs to be paid. Questions there?
Will this be on the test? So I just have to just put the answer, right?
There are questions where they ask you, and it gets a little bit more complex in this, and it's actually in chapter, believe it or not, right, in chapter 14, where there are questions where the company kind of just declares a dividend of some total amount. Like, let's just say they declare a dividend of $100,000, you get told that the preferred stock is cumulative, you know, they haven't been paid for X amount of years, then you have to calculate how much of the 100,000 goes to preferred stockholders and how much goes to common stockholders. So yes, this does come up in the homework and it does come up in the test. And this is just an amount. This is not yet the journal entries. The journal entries will come in, I'll show you in a minute, in chapter 14, how to journalize a dividend declaration. Any other questions here, guys? So this is, just to be clear.
Yeah,
this
I
is
have a
what's owed.
question.
Yeah, go for it.
For example 18A, can you, no, example 18B. Can you please repeat that step over because I'm confused?
Yeah, so
Like how you got to that.
Sorry, let's just read the question again. If no dividends were paid in 2018, right? So that already means they're owed something because remember it's cumulative, right?
Yeah.
Yeah. How much dividend is owed to preferred stockholders at the end of December 2019? So we're in the next year now. So if these guys are entitled to a 7% dividend on, you know, the par value and the shares, and it's cumulative, it must then mean that by the end of 2019, not only are they owed the 2019 dividend, they are also owed the 2018 dividend.
Oh, I think I get it, because the 5,000 shares times the 7 is 35,000, and you would add 35,000 by 35,000
twice. And this number is static, the 35,000 for 2019, because there weren't any additional shares issued, right? So you can just carry that number twice.
Oh, okay.
Because this is the 35,000 at this point is the annual. Maybe this will also help to clarify. It's the annual dividend, right? And I think the question asked it in that way. It said, how much? What is the annual dividend? So every year these people should be getting 35,000. They didn't get it in 2018. They're waiting for it in 2019, so they're owed already 70,000.
Okay. Makes sense now.
Okay, and if the dividend had been non-cumulative, and we'll see this, pardon me, and we'll see this in chapter 14, if it had been non-cumulative, then in 2019, they would only get 35,000, because non-cumulative means that if the time passed and you didn't get paid, it's too bad. You are not going to be able to carry that money forward. All right.
Okay, so if it had been issued now, it wouldn't have been the 35,000 twice. So it'd be a different number.
If it had been issued now, what do you mean by that?
Like it wouldn't be 35,000 plus 35,000. It'll be another number. So you wouldn't have to put 35,000 twice.
Yeah, if it had been non-cumulative, you mean, or if more stocks had been issued. Is that what you're asking me? Yeah, if more stocks had been issued, then the annual dividend amount would change. Like let's just assume, I'm just, you know, making up stuff here. I hope I'm not confusing people too much. Okay, let me actually just get this away from here. Let's just assume over here that I mean, the par value is not going to change. The percentage is not going to change because those are contractual. But let's just say now that instead of 5,000 shares, they issue 3,000 extra shares, and now it's 8,000 shares. All right, in 2019. So now what's going to happen is you've got 100 times 7% times 8,000. So it's a 56,000 dividend now, right? This is 2019. So what happens, and hopefully this is not at the risk of driving everybody nuts here, but I just want to show you what happens is that 2018 would still be 35,000, but because things changed in 2019 where the number of shares actually went up, now what is
so
owed,
it'll be 91,000.
What is owed is bigger now, but that is only because we are assuming now that the shares change. And so that's why I said this number, this 35,000 is going to stay the same every single year unless the number of shares that are issued changes. And that's why I could just copy and paste the 35,000 for 2019 because I knew that there was no change in the number of shares.
Okay, I get it now.
All right. Any other questions? All right, so that concludes chapter 13. All right, so I just want to sorry, someone might still be looking at this, so let me just leave it up. But I just want to reiterate, and I know I sound like a stuck record, but I just want to reiterate that chapter 13 has many concepts, and small concepts that you have to remember. Over and above the stuff that we journalize, there's also, these concepts of what's an authorized amount of shares, what was issued, what is market value, par value, no par value with a stated value, the balance sheet, treasury stock, issuing preferred stock. It's a lot, okay? So your homework for chapter 13 is due on the 6th of April, which is next week, Monday. I made it like that so that if people are still struggling with things, you have a little bit more time, but also we can maybe save some time at the end of the call on Monday for people to ask questions, and or you can come to the office hours on Monday afternoon, or just keep sending screenshots like you have. But this is a lot of work, and you might get it once by looking at the textbook and answering the questions simultaneously, but that's not going to be enough for you to be able to complete the tests successfully. You actually do need to, really need to study this work fairly comprehensively to be able to be successful. All right, so again, that's chapter 13. I don't think, it seems like people don't have questions now, but I'm sure as you go into the homework and you have to actually put pen to paper, you'll probably start to see questions popping up, and at that point, just contact me. All right. I don't want to go overboard here with starting chapter 14 because we're almost at the end of our time, but I'll just give you a preview and maybe just talk through it a little bit, and then we can pick up more next week. So just in case you don't know where to find this information, chapter 14 class notes under the Zoom call materials, that's what I'm using right now to just do a little bit of an intro into the chapter, and then we'll pick up some more next week. So chapter 13 and 14, like I said, they're very much linked together. You can see that we just ended on preferred dividends there, and now we're starting 14, and it's about dividends also. It's about retained earnings. We spoke about retained earnings briefly. We said that it's the capital that the company earns, right, as opposed to the capital that people are paying in from the outside. This is basically all the net income that the company has earned over the years and has not distributed as dividends, right? Retained means that you kept it back in the company. So it's net income, profits and losses, or whatever. In this case, it's a positive number. So it's profits, right, that was earned over time that wasn't distributed. And just to remind you, especially when you start your homework, the first thing that we did in chapter 13 was the transfer of the net income to retained earnings, right? So that also should remind you what retained earnings is. It's a sum of all the net income over the years. And then income reporting, this is a fancy way of saying the income statement. So you might remember when we were doing sole proprietors, when you were doing that in accounting 1, and then also when we're doing income statement for partnerships, you don't have any tax line item in the income statement for sole proprietors or partnerships, because they are considered what we call flow-through entities, meaning that the partnership and the sole proprietorship don't get taxed. It's the owners that get taxed. But with a company, the company is a separate legal entity, so it will get taxed, which means that its income statement will look slightly different to the other income statements that we've seen. And the main difference is going to be that you'll have income before tax, then you'll have the tax expense, and then you'll have net income. That's really it. So dividends, we kind of spoke about this a little bit before. A dividend is a corporation's distribution to stockholders. So we're either doing a distribution of cash, which is, whatever net income we earned, we have retained earnings and we're going to distribute some cash, or you can also distribute stock or property or whatever. For our purposes, we'll just focus on cash dividends and stock dividends. And again, stock dividend just means that instead of paying out cash, the company is actually paying the dividend in extra stock that they are giving to the stockholders. Sometimes they do that because they want to give a dividend, but they don't have the cash. I mean, if in order to give a dividend of cash, you obviously have to have the cash. So they don't have the cash on hand, or they want to hold on to cash, so they just give stock. And it's on a pro rata basis. It's a fancy way of just saying, like we had before in our previous example, if I own 1 share, then and the dividend is $7 per share, then I get $7. If I own 2 shares, I get $14, 3 shares, $21, and so on. So it's always proportional. The amount of money you get will depend on the number of shares that you own. And so, like I said, there are different forms of dividend. Don't worry too much about anything except a stock dividend, which is one of the things that we'll focus on, and then a cash dividend. Everything else is a little bit more like niche issues where, you know, you have smaller companies that might distribute a piece of property or something like that. Don't worry about that. Focus on stock and cash. A dividend can be expressed as a dollar amount per share. So you're saying, okay, we're going to declare a dividend and it's going to be 50 cents per share. That's one way of you know, stating the dividend. Another way is what we just saw in chapter 13. It can be a percentage of the par or stated value of the stock, right? So that's mostly what happens with preferred stock, where the dividend is an actual percentage and you have to calculate the total amount of the dividend. Whereas when it's common stock, it's normally not a percentage, it's actually just a dollar amount per share that the company declares. And then some more theory here. There are 3 dates that are important when you look at dividend declarations. So declaration date is the first date, and to declare something obviously means to say something. So that no one gets a dividend until the board of directors of the company actually declares a dividend. So they actually have to say that we are going to pay a dividend. Even preferred stockholders, they might say, yes, I have a cumulative preferred stock and I'm supposed to get, you know, $7 every year. But until that dividend is declared, they don't get anything. And the arrears just keeps growing. So in order for there to be a liability for a company to owe you a dividend, it doesn't just mean that you can be a stockholder and so automatically you are owed a dividend. A dividend has to be declared first. And so this was what was happening also some years back with stockholders in Apple. Apple had a ton of cash on its balance sheet and they just refused to declare any dividends. They just kept saying they wanted to keep the money for reinvestment in the company. And the stockholders are not entitled to anything until the dividend is declared, but eventually they fought really hard with Apple, telling them, you know, that there's no need to hold on to such billions of dollars of cash, and that they should be paying some type of dividend. And eventually Apple conceded and declared a dividend, and only at that point of the declaration were the stockholders actually entitled to anything. The record date is the second date that we want to take note of. The record date is the date on which the company determines who actually owns the share. So you might say, well, isn't that obvious? Not really, because remember, the stocks are being traded all the time on the stock exchange. So today I might have, you know, 10 shares in Google, but if I decide to sell them all to someone else, then I'm no longer the owner. And so if a dividend gets declared, I need to make sure, and the company needs to make sure, who the dividend should actually go to, like who is entitled to that dividend. So on the record date, there's no journal entry that gets made. It's basically the company going through its records to try to figure out who the rightful owners are of these shares, and therefore who they should send the dividend check to. And then the last date is the payment date. That's obviously when the money actually gets gets distributed to the stockholders. And so, just a little bit more about the declaration date. The board of directors, we spoke about this, right? The common stockholders vote to appoint the board of directors. They declare or authorize the dividend and they announce it to the stockholders. And then at that point, the company is committed and they have a legal obligation to distribute the dividend at no time before that. So that's the declaration date. I'll just say a little bit more. We will deal, like I said, with cash dividends and also with later on, yes, stock dividends. Cash dividend work is by far easier than stock dividends. In fact, stock dividends is probably the hardest part or one of the hardest parts of this chapter. So we'll go slowly over that. So for cash dividends, in order to pay a cash dividend, the company must actually have positive retained earnings. A company that has been making losses for years and doesn't actually have retained earnings cannot distribute a dividend, because a dividend is distributed out of the earnings that have been kept back in the company. So if there's no retained earnings, then there cannot be a dividend, even if there's some cash on hand. They also have to actually have the cash that they want to pay. So you can't declare a dividend and say, I'm going to pay a dividend of 50 cents per share, but then you don't actually have the cash to pay it. And if you do have the cash to pay it, but you don't have retained earnings to pay it out of, you also will not be allowed to declare the dividend. And then the last piece is that the dividend actually has to be declared in order for a company to be able to pay a cash dividend. So I mean, you can see already, yes, the beginning of the journal entries. I'm going to leave it there. We don't have to push so hard. I think we've done enough for today. If anybody has a question right now about, the beginning of the dividend stuff, I'll take your questions. Otherwise, I'll just hang around here until 12:45 in case people have other questions or concerns.
Can we do the first example?
I'm not going to do it now. I'll do it on Monday. Otherwise, it's too much. I have to gauge my audience. If you want me to do it with you, you can hang on. Let me see if there's any other questions. Then I'll do it. I can do it now for those who want to stick around, and then I'll do it again on Monday. How's that? Okay?
Yes, thank you.
Okay. Now does anybody have any major questions on 13 or the beginning of 14 that they need me to cover or revisit something?
I don't know if you can hear me. I have.
Yeah, I can hear you now.
Okay, so I was losing connection when you were explaining the theory of treasury stock. I was wondering if you could go really briefly into it.
Yeah, I think you were trying to talk to me at that point, and you were dropping in and out, right? Yeah. Okay. So sure, I can go over this quickly. Not a problem. So treasury stock, you understand, right? That treasury stock is obviously stock that the company owns. It's shares that were issued before to investors outside of the company, and now the company bought the shares back for whatever reason. I mean, it could be a number of reasons, including just that they want to push up the stock price, or they want to buy shares back to issue it to employees as part of a stock option plan, or any number of other reasons. Are you okay with that piece?
Yes.
Okay, so the first thing to remember is that, yes, the treasury stock account does show up in the capital section of the balance sheet, but it's actually what's called a contra equity account. So it's an equity account, but instead of having a credit normal balance, it has a debit normal balance. And the way it's treated is that it's also subtracted from the stockholders' equity balance, because stockholders' equity is showing everything that is owned outside of the company, and treasury stock is owned inside of the company, so that number should not be included in stockholders' equity. So when we purchase treasury stock, we use something called the cost method, meaning that you ignore anything to do with par value or stated value of the stocks. You focus purely on what was the cost of the stock that you purchased, and that is what you record as a debit to the treasury stock account. And so again, treasury stock goes up on the debit side when you buy the stock, and the credit is going to be to cash. So when we were looking at, just 1 second, when we were looking at these journal entries, right? We, for example, 12, for instance, we had said that this company buys treasury stock, 4,000 shares of its stock, which tells you that that's a treasury stock transaction for $8 per share. So there's the cost of the stock, there's the number of shares. So you're literally saying debit treasury stock 4,000 times $8 is the 32,000, and then cash is credited for the same. Still with me so far?
Yes, I understand.
All right. And so again, when we look at the balance sheet, you've seen this now, we've kind of seen it a million times, but I'll just show you the balance sheet that I built over here as well. That treasury stock is deducted from the paid in capital and retained earnings, so that we don't get confused and think that it actually belongs to people outside of the company. And a company can buy the treasury stock, obviously, and they can also decide to sell it at a later point. And when they decide to sell the treasury stock at a later point, what we have to be very careful about is that that's going to be a credit to the treasury stock account, and the amount of the credit is always going to be whatever the cost, original cost, right? When we bought the treasury stock, whatever the cost was of that treasury stock multiplied by the number of shares that are being sold. So if we go back to this example, the company had bought 4,000 shares at $8 per share. $8 is the cost, right? In example 12. Then in example 14, they sell those same shares, okay, but they sell them for $10 a share, and they don't sell the entire lot of 4,000 shares. They only sell 1,000 shares. So cash is going to be what you actually received for each share multiplied by the number of shares. So that's 10,000. The treasury stock will go out at the same cost, right? At the same amount that you paid for it is what it's going to go out at. It doesn't matter if they give you a par value in the question or something like that. You basically, unless it says that the treasury stock was sold at par or something like that, you don't have to, you can basically ignore par value, okay? So $8, the original cost times 1,000 is 8,000. So this is why we call it the cost method. It goes in at cost and it comes out at cost. And then the paid in capital from treasury stock is the account that receives the excess. Since we sold it at 10, but we had only bought it at 8, 2,000 extra dollars goes into this additional paid in capital account.
And what if you sell it less than what you got it for?
Yeah, so that's what I was saying. You know, I was showing it a little bit in the textbook. You are not required to deal with that piece, but you know, for the sake of completeness, I'll show you guys again. I'm not going to test you on it, right? That's what I'm trying to say. But for the sake of completeness, I'll show you. It is over here in the book. If you sell it below cost, your paid in capital from treasury stock becomes a debit instead of a credit.
Oh, okay, makes sense.
Mm-hmm. So yeah, it was above cost, so obviously you had extra money. If I'd sold this for $6 per share, right, then I would have 6,000 here, but I'd have 8,000 here. So I just have to put in 2,000 on the debit side to balance it, and that would still be called paid in capital from treasury stock, unless we have no money left in that account, and this is where it becomes even more complex. There's no money left in this paid in capital from treasury stock account. You actually have to use the retained earnings account as the debit. But again, I repeat, I'm not going to ask you for sales below cost. We really are only focusing on sales above cost, because in business, in reality, that is the 99% most likely scenario that's going to happen. Like a company would be making very bad decisions if they buy treasury stock at a particular price and then go into the market and sell it for lower than that price. I mean, it makes no sense. Is that okay?
Yes, thank you.
All right. So anything else before I go over the cash dividend question? me see if anybody's hitting me up on chat. Sorry, Shazid, I missed what you were asking me for question 18. Okay, hang on. No, oh, okay. This is the no. So you're asking me if there are any debits or credits needed in example 18, and the answer is no, because you weren't asked to journalize anything. You were only asked to calculate the dividend amount for annual dividend amount, and then you were asked to calculate how much dividend is owed. So there's no debits and credits. You have debits and credits when the question is asking you to journalize, journal entry, right? When the question is asking you to journalize the transactions. Hopefully that helps. All right. For cash dividends, I think Jimmy, you're still on. You were asking me to go over this. So anybody else who needs to fall off, you can go. If you want to listen to this cash dividends piece, you're welcome. You'll hear it again on Monday anyway. So journal entries for cash dividend. On the declaration date, you definitely do have a journal entry because that's the date when the liability actually, comes into place for the dividend. So when the company declares a dividend, you're going to debit cash dividends and you're going to credit dividends payable. Cash dividends, this account actually closes off to retained earnings. So that's why I was saying that dividends are actually distributed out of retained earnings, even though the book, years ago, the book used to just do debit retained earnings, when they changed it to cash dividends. But the reality is that this cash dividends account is kind of just a placeholder type of account, because eventually this balance will be deducted from retained earnings. So you debit cash dividends and you credit dividends payable for whatever the amount of the dividend is on the declaration date. And I wrote here that we debit retained earnings. That is when we close cash dividends off to retained earnings. Dividends payable is a current liability. It's an amount that we expect to pay within 1 year from the declaration date. In fact, it will probably be a few days or a few months from the declaration date that the amount will actually be paid out. So it's definitely a current and not a long-term liability. For the second date, which is the record date, the company will just simply determine ownership of the outstanding shares. There's no journal entry that you need to make on the record date. All right. And then the last date, which is the payment date, you can see what happens is you get rid of the liability, right? The liability went up on the credit side of a year. So you debit the liability, dividends payable, and you credit cash. That's to show that you are now settling the amount that is owed to the stockholders. So then eventually the overall impact of a cash dividend is to decrease retained earnings via the cash dividend account and to decrease cash, which is exactly the point, right? When you make a dividend, you're distributing some portion of the prior net income to the stockholders. So that's the minus on retained earnings, and you're giving them cash. So that's the minus on cash. Is that what you wanted me to talk about?
Oh, no, I wanted to go through the example with you just to practice.
Yeah, I have other commitments starting at about 12:55, so I can take you through the first, let me see if I can, did I pull it down already? I can take you through the first part of the first example, but I won't be able to stay on much longer to go through a whole lot of examples today because I don't have office hours today. So let me just read. I'll try to do number 1, ABC, so then that at least shows you the flow, right, of the dividend. So on December the 1st, 2018, the directors of Media General declare, so that's the declaration date, a 50 cents per share cash dividend on 100,000 shares of $10 par value common stock. Journalize the dividend declaration. So over here, you want to be careful. You don't actually need the par value for anything, because the way you calculate the cash dividend is the dollar amount declared per dividend times the number of, per share, excuse me, the dollar dividend amount declared per share times the number of shares. So what's the amount, Jimmy, what's the amount going to be for the dividend?
50,000.
Yeah, so that's all you're doing. We're going to put a debit. Is this still fairly legible? Yeah, it looks a bit small, but can you see it?
Yes.
Okay, so you're going to debit cash dividend or cash dividends, whichever, and you're going to credit dividends. I'll just put because I'm going to run out of space. You're going to credit dividends payable, and you're going to say 100,000 times 50 cents, so 50,000 for both, and that's what you journalize on the declaration date. So far, so good.
Yes. For a second there, if you didn't tell me that, I would have times the 10 to the 1,000.
Yeah, that's why I know. that's why I pointed out that you don't need that, because remember, the only time when you use a par value in the calculation of a dividend is when you have like that preferred stock percentage, right? Where you have the dividend is a percentage of the par value at that
As
point.
long as it's not a preferred stock, I don't have to worry about the par.
Yeah, that's probably the most succinct way of saying that. On the record date, I told you guys already, there's no journal entry, because that's just a date when the company looks at their records to say who is actually owning the shares, right? So it doesn't matter, no journal entry. And then for the last one, this is on January the 20th, they pay the dividend. So remember, now you get rid of your liability and you are paying out cash, and it's going to be for the same amount. And that's a cash dividend. Even for the next one where you see it's a $2 on 100,000, same deal. You just multiply the dollar amount by the number of shares, and you go through on the declaration date. It's kind of like a slam dunk situation. On the declaration date, it's always debit cash.
For 1B, you just put the date? No.
I mean, you'll see what they ask for on Wiley. Sometimes they want the date, sometimes they don't care. I didn't put the dates now, but I mean, they may not even leave you space to put no journal entry. You can just skip over the record date.
Oh, okay.
You got me? So sometimes they'll jump from December the 1st to January the 20th. I'm putting no journal entry here so you guys can know, like when you do the homework, for instance, that you're not trying to process a journal entry that doesn't exist.
Yes.
For that date. All right. That's cash dividends, and then we'll do some more next week. Of course, as with everything, there's ways to complicate this maybe a little bit more, but not by much for cash dividends. I think the things that you want to watch out for in this chapter is when you have to allocate, and this is number 4, when you have to allocate the dividend between preferred stockholders and common stockholders, when the preferred stock is cumulative.
Oh, yeah, when there's multiple dates, because I looked at, you had to keep going back and forth.
Yeah, and the other thing that is hard in this chapter, in my opinion, where people really struggle, is stock dividends. All right, so just read up a little bit on that. I will go as slow as a tortoise through this stuff on Monday, so that people can just feel fairly confident about the situation. All right?
Perfect. Thank you so much, Professor.
Okie dokie.
Have a wonderful week. See you on Monday.
Yeah, it was good to connect with you guys. I actually always look forward to my classes. I feel like I'm in civilization when I'm talking to my classes. All right. So have a good weekend. Always email me if you guys still have questions about something. All right.
Thank you.
Okay. Bye bye.